Good morning and welcome everyone. Today is Friday, the expiry October 21st, 2022. Please write in the chat box that you can hear me. My name is Josip Kosik and welcome to Trading with Unfillorders.com. We are not financial advisors. Please take a moment to read this disclaimer, even if you need to stop it. We are going to be teaching today the call broken wing butterfly, and I'm really excited about it. And what I like to do now is I want to make sure that uh, you know where to contact me. So this is a contact uh, at tradingwithufos.com. I'm gonna just circle here. This is a website where you can reach me, and I want to make sure that we're all good to go here. So without looking at what the market is doing, we should first visit our setup here and look at it. What's the S&P 500 that is being tracked by the ETF known as SPY doing. And we have here daily of the SPY that is basically stuck in the range between 38 and 36. And we are right now dead in the middle, dancing around the 37. And now what is really important for us to understand that if you look at the bigger picture, and the bigger picture is always the monthly, on a S&P 500 that is tracked by the ETF SPY, you're able to observe that we had a very, very strong uptrend that has started all the way back in the March during the COVID of the 2020, and it has been unbroken, coincidentally, till the March of this year, right? So February we touched it, we bounced, and then in March we closed at the low, and then we took out that low of the February, and then we created a new low, and this is where we currently are. We are stuck here in a range. And really, one of the things that I want to point out to you is that when we are stuck dead in the middle, uh, at that midpoint of the range, there's really, from technical perspective, worst possible place to be truly in, and to try to discern the next move. So if I just show you like on the 10-minute bars currently, um, we are unsure which way to go. In terms of the percentages, S&P has moved 0.18%. NASDAQ has moved same 0 point something to the downside, and Dow just doesn't know which way to go. The predominant color right here, it's what is looking to me like a Christmas, like it has a green, has a red. There's no clear indication which way to go. Hence, the hint, why I would like to teach the call broken wing butterfly. And what the call broken wing butterfly is actually two spreads. And I'm going to just kind of create it here, and then I'm going to open up the Thinkorswim platform and fire it in. So first one is the debit spread, and that's actually the one that is known as a bull call spread. The other one is a wider credit spread that is going to receive enough premium to pay for that bull call spread debit. And the name of that strategy is a bear call spread. Now notice the key thing here, bear call would mean that I want it to go down, and a bull call means that I want it to go up, which is actually perfect situation to what we currently have in this kind of environment. So let's now revisit simply one more time the chart and look for the UFOs to the top side and those unfilled orders to the bottom side of the S&P 500 and decide where can we position that. So again, all that it needs to happen on this particular trade, and I'm going to type in here @ SPX.X. Thank you for confirming that you're here. I really appreciate it. Is that we are shooting in this area around the 37.65. Okay, so this is where I would like to have a gut of my 37.65, 37, 36, 75, 37, 35. So I'm considering taking into account that the SPY is right now at 36.72. So I'm going to just record this. At this moment, the SPY is basically, let's use a number that around 36.73. And I'm looking here at 36.47, 36.47, 36.75. That would be to the downside, and to the top side 37.35. Okay, 37.35. 37.35. Okay, so we're gonna have a buying to open 37.35, and if we buy that, we also want to make sure that we sell something above it, and what we want to sell above it, it's going to be an obligation. So 37.40. So both of them are going to be calls, and both of them going to be out of the money. Now, why would I ever want to do that? Because this out of the money bull call spread is going to get financed by the bear call spread. So what I'm going to do, I'm going to fire this trade in. I'm going to open up here a Thinkorswim platform in 30 seconds here, and you'll be able to see it. And in that case, I'm going to be placing this particular trade in account. So let's go here. So here in this account, we have about let's change this to SPX, and it's opening it up. So we're gonna take today's option. So by the time I have a next class with you, which is on Tuesday, I'm gonna be able to go over this trade. So what I did here, I have set up the intrinsic at 0. So you would see that the intrinsic here at 0 would be all out of the money. And we were looking at 37.35 area to buy, and that is really quite a bit away from the current price. It's about 40 points away. That particular contract cost me $1.40. Now, what I want you to notice here, if I scroll it down, it has a lot of activity. It has a lot of activity. So I'm going to circle exactly what I'm trying to do here, so it will be obvious how we're going to go about it. So I'm circling this area around the 37.35, the unit that I'm buying, and in red I'm going to make the 37.40, which is the unit that I'm selling. Okay, but what is interesting, because I'm going to make this as a broken wing butterfly, I'm going to be then selling 2 of these 37.40, and I'm going to be also buying the higher unit, which is a 37.55 or even something higher than that. Okay, so how do we go about executing the broken wing butterfly in a one shot? Well, first of all, we need to put the mouse on the one that we like to buy. And then when we bring it up, we need to proofread it that it's doing exactly what we want it to do, right? So one more time. So we are putting the mouse on the one that we are planning to buy. And we are planning to buy 37.35, and a gut is a 37.40. And right now this says a debit, but if I move this up higher to 55, it's giving me a credit. So now be aware of it. This would mean that I'm getting the 30 cents credit if I'm dead wrong. 30 cents credit. Could I change this to the different price? Sure. If I drop it down, then I'm getting only 15. And in this case, the 15 is $15, right? So what I'm doing right now, I'm firing this trade in, and I got filled for a 15. And this is as much theory as you're going to get here in the terms of the execution of it, because this thing that I did exactly at 8 o'clock, 8:09, is going to be now broken down into pieces and explained using our platform, trading with unfilledorders.com. So let's now make sure that we got all the information correct. So buying to open, 37.35 call has costed me a debit of the $1.35. Luckily, I was able to turn around and to sell the higher strike price, which coincidentally is 105. So when you're looking at this total debit is only about 30 cents. It's 30 cents. So now that I have this, I want to make sure that I explain what is this bull call spread. So this bull call spread is nothing else but the bias to the upside with the same mindset as a purchasing the long call. Now, why would anybody in their right mind want to go out and purchase a long call when the current price is at the 36.84 and we are now buying the call all the way up there at the 37.35, and that's the call, right? So it seems like it doesn't make sense. The reason why I'm looking at that 37.35 because it simply matches the whole idea of what the UFOs are showing. So UFOs are showing right here that in this area, the red unfilled order, the lowest end is at 37.35. So if we have a violent action being the expiry to the upside, with the people least expecting that kind of move because they keep looking, oh, the market is somewhat down, probably we're gonna go lower, because look at these highs, they're consistently getting lower and lower. So this is not the higher high, this is a high, this is a lower high, and this is another lower high. So they're expecting this can happen lower, but usually at the expiration, it's a bullish day, and in case we lift, we might rally up to 37.35, which means that at that point, my 37.35 call is going to accumulate some money. So if it accumulates some of the money, what my expectation is that it's going to lift at least up to the sold units. And this is a sold unit at the 37.40. So if that happens, that we ended up closing. So if we ended up closing at 37.40, that would make my long unit, my long 37.35 call, ITM stands for in the money by whole $5. Now, of course, out of that $5, I would need to subtract that 30 cents credit to realize that the real cost, the real profit, the maximum profit of it was $4.70. That is my logic. So let me now break this down in simpler terms. So I'm pulling up here option chain. Here's the SPX. And I'm going to make sure that I pick the expiration that is for today. And I'm going to go over here where it says instead of the long call, I'm going to edit the spread. I'm going to add one more option leg, and that's going to be the leg that we are selling. And then I'm going to line this thing up exactly to the October 21st, which is an expiry, but it needs to be the expiry of the weekly. Weekly means the ones that still have about 5.5 hours left of the trading, and alter it to the 3740, which is my unit that is on the top side, and on the bottom side is the 3735. So when I click this OK, this thing is projecting me 30. Now it's dancing. If you're looking right here, it's dancing to 40 cents, but I want to actually edit this with exact numbers that I got filled on my Thinkorswim platform. So I was able to sell this for 105, while over here I was able to get filled at the 135. So when I click this OK, it shows exactly my price of the bull call spread in terms of me getting filled. So this is what it is. So I have gotten filled right here for 30 cents of the debit. That 30 cents of the debit is also giving me a nice profit, and you can find that out simply by clicking here and going to the risk graph and then enlarging this area where it says $4.70 of the maximum profit. Now, you can talk about probability of that happening not being very high, and that's exactly where I am teaching this morning. Broken wing butterfly, but on a call side. So let me now place this whole thing in so you have this thing side by side so you understand that if we are closing at that 3740 today, which is very possible, then this particular long call of the 3735 would have an intrinsic value if we are at 3740 of the entire 5 points. Good point right there. This needs to happen if the market rips, but if it doesn't rip, then what are we gonna do? Well, we're gonna have this other trade. But let me now one more time teach slowly what is a bull call spread. Well, bull call spread has two words. The first is an adjective that says a bullish or a direction, and the second word is a noun that simply says a call. So call by itself means nothing, because as you can see over here, I have a bear call and I have a bull call. French Canadian, English Canadian. The word Canadian, it doesn't mean anything linguistically till you add the adjective to it to describe it, right? So be aware of it, that what we want to see in this particular situation, we would like to see the market go where? Up. And we want a market to close in that area of that UFO, which is intention for a bull call spread. So bias is to the upside. It's the same mindset as the purchasing of the long call, but disclaimer needs to be there. A minor rally, us rallying, let's say only a couple of dollars, it's not gonna do anything for this out of the money call to overcome that whole the whole cost of it. So just be aware of it. We need to have a significant rally, and as of now, we are not rallying. We are sitting here at basically 3680. If we are now sitting at the 3680 and I have bought 3735, I'm basically 55 points. So 55 points out of the money. So as I gave disclaimer, please don't take this date. It's for educational purposes only. I want you to understand, as the market is going up, there's also decrease in volatility, which hurts our spread. Because if the market is going up, that means less fear in a market. And the less fear in a market means that the volatility, which we can nicely track here, if I'm going to just change this to the SPY, is going to be obvious that it's going to be going lower. But as of now, the blue is above the gray. So be aware of it. One color represents the calls, other represents the puts, right? So on our auto climate, we really don't have a very, very clear trend because, as I mentioned to you on a daily, we're simply stuck between these round numbers 3,800 and 3,600, and we're somewhere around 3,700. So we've been in this range. Let me go back again on S&P 500 because SPY is just a smaller version of it. So there's a 3,800 right there, and if you can just see here, I'm gonna be boxing it. 3,800 right here, and there's a 3,600 right in this level. So we're really stuck in this range over the period of almost a month and a half, with exception of that break below and then violent bounce back up. So be aware of it. As the market is going up, there's going to be decrease in the volatility. On the positive side, right, the bull call is going to benefit from a large move. So when the question becomes which size call to be selected, because I'm teaching the class again on Tuesday, I want to make sure that you know the outcome for this trade. And as I said, the worst possible outcome for this trade is that nothing happens, and then all that it's earned, it's only this $15 credit, and this $15 credit is enough to pay for both of the commissions on both of these spreads, on the bear call spread and also on the bull call spread. So just be aware of it. That's what is the theory behind it. So let's talk about the timing of the entry. The underlining must be selected that has a clear setup. So observe where the unfilled orders are, and our unfilled orders are represented by this red saucer, by this red flyer right here. Now I have went down to the smaller time frame. I think it was a 55 minutes when I have selected that particular level. And on a 55 minutes, I have observed that that's the unfilled order that is acting as a possible target and also as a possible resistance. So I have selected the call below that level, and then I had sold the call above that level. Hint, hint, hint. Therefore, when I bring it up here, it's obvious that I have looked at here 37.35, and I have purchased the 37.35 due to the fact that I know that this 37.35 is a lower part of this red unfilled order. The simultaneous execution was done. As soon as I have purchased that, let me just change this color into red, I have sold this one right here. And this one that I sold for $1.05, which wasn't even my money. It was the money that was paid to me by the market maker in amount of the $1.35. So when I say $1.05, that's $105. When I say $1.35, that's $135. Just be aware of it. That's what is happening. So in a single line, what is the bull call spread? We are buying a lower strike price call and selling the higher. That's it. It's two building blocks. First leg allows the owner to buy the underlying from someone else when it rallies. Okay. Now this is a cash settle index, so there won't be buying. any of this thing if the stock, if the underlying, if the index is out of the money, right? Which is the whole reason why I'm doing this on the day of the expiry when everything settles in cash. Let's talk about the second leg. So the second leg is the selling of the call. That selling of the call offset not all of the debit, but some of the debit of that call buying. So this call buying really was out of my pocket, $1.30 35. But my logic is like, why would I pay the whole $1.35 when I can finance it right here with $1.05, which is the reason why I ended up getting this 30 cents of the debit. Now I have financed that with bear call, but I want to make sure that first explain this whole thing properly, what the bull call spread is. So in both cases, uh, both cases meaning like both units, the first leg and the second leg, right? What it can happen that the rapid move up can happen unexpectedly, and then call, out of the money call is going to become at the money or what is called near the money. Okay, so should you be exiting early? No, we actually want to hold this all the way to the expiry, and if the bell rings and we close exactly at the price, and let me just enlarge this one more time, of the 37.40, then that long 37.35 call is going to be in the money by 5, but you can't say you made the $500 because you paid for a debit of the 30, so your maximum profit is 70. So right now it's 8:26, it's about the halfway through. I'm going to now move on explaining what is this bear call spread. Now this bear call spread, okay, this bear call spread is the flip side of this. So if I go back to execution platform just for 30 seconds here, so you can actually see what is going on here in the terms of the position. So I have a position here, I have a position here, and this is intrinsic here. And I'm going to just change this intrinsic for a second here so I can show the numbers. Okay, so I have a long 37.35, and I have a short two of these. Let me do this in red. 37.40s. Well, how can that be? Well, that's why I'm talking to you about the bear call spread. Bear call spread has a higher unit right here. So when you combine these two things together, the bear call spread with the bull call spread, you get a strategy that is called call broken wing butterfly. And that is the topic of today. Adjective is a call. It describes what kind of BWP we have. So broken wing butterfly can also be a put, but in that case you would need to say put broken wing butterfly. In this case is a call. Now this can be skewed in any way. Right now this is a slightly bullish bet, but it can be skewed in such a way that it's also bearish bet. But this is too much for a one lesson. I just want to make sure that I pedal through this and explain this to you from the beginning to the end. So this is the time for you to type in the chat any questions that you have about the bull call spread, and I will pull up the option chain and start preparing the bear call spread while I'm monitoring the chat to see if you have any question about what I have covered so far. Your silence is going to be interpreted as that you are following what is going on. So one more time, I have switched here on the platform to the bear call spread. I'm clicking the button to edit. Of course, we have a sell and we have a buy. And I will need to now switch this to the current option, which is a October 21st. Now, there's a question here. Why do we have a 2 October 21st? Okay, so let me just explain this very simply. Last day that this October 21st expiry without the W was able to be traded was on Thursday, but the settlement price is Friday open. But obviously on Friday open, I can't trade this. So these will be the regular monthly options that just happen to be expiring on a Friday of the expiry. California time 6:30, New York 9:30. When they have introduced these weeklies or daily options, whatever way you want to call it, because this October 21st with the W was out there, but today it's almost acting as a daily. They had to distinguish it because that now has a PM settlement. So it still has a life in it to trade. So having said that, I'm going to now alter these strike prices to the same strike prices that we did before. 37.40 is the gut of the butterfly. And what I have done for the buying, I actually bought 10 points higher. That's meaning in that case, I'm risking almost $1,000. On the previous one, the risk was only about $500. But on this one, his risk is $1,000. So if I would click now OK, they would spit out the number right here. And that number that they spit out is really not the number that I ended up getting, right? So I would need to make sure that I actually alter one more thing here, and that is the expiry. Expiry needs to be set up on October 21st. When you change one, all of them change. And I'm going to click here what I got filled. So 105 was the unit that I sold, but the unit that I ended up buying, I bought for insignificant 60 cents. Where I'm getting that information, I'm getting that information from a snapshot that I have taken after I have gotten filled here. So here's the 60 cents for the unit that was bought. And this unit that was bought is 37.50. I paid for it 60 cents, but never mind, I actually got the decent credit back because this unit right here, ignore that it says a 2 because I'm explaining it as a 1 in isolation. And because I'm explaining it in isolation, you just need to focus on what this whole thing is in separation from each other. In separation from each other. So having said that, when I click here OK, it's going to spit out that this is a 45 cents. So this is now 45 cents. So if this is now 45 cents here, I'm going to follow the same steps that I did before. Same steps. So on this side, I have a bull call. Right next to it, I'm going to add a bear call. Maybe I can do this in a better way. So just give me 1 second. There it is. So you have a bull call on this side. Over here you have a bear call. And then the most important part of it, and this is what I want you to focus on, not the profit. Only profit that is here is $45. I want you to focus on how much is at loss in this particular risk graph. Ready, set, go. You might be completely scandalized because in this particular case, let's go back here for a second. In this particular case, I was about to use the red. The risk is $955. Why would anybody in their right mind do this? You shouldn't do this separately. You should do this as what I like to call combo. But I need to explain this in pieces so that we can understand this in pieces. And let's just make this thing simpler over here by creating the two boxes. One is going to be for the bull call, and one is going to be here for the for uh, uh, for a bear call. So I'm putting the bear call information in, and I'm going to take this and put that in here. So you have all the information side by side. So now notice here, okay? I'm risking here $955 so I can make 45. That 45 in turn has paid for this 30, therefore you get this 15. So let me explain this one more time without rushing to it. This 45 is a credit that has knocked down this 30 cents debit down to the still credit off, and we can make this in a green, of the 15 cents. So if worse comes to worse, all that I can make, even if I'm dead wrong, is the $15. I will combine this before the session ends into two, but what I need to do right now, explain what is their call spread. And while I'm ready to explain what the pair call spread is, I just want to glance on what the market is doing. Market is now approaching the 3,700. Okay, it has another 2 points to go. Right, when we have entered, it didn't look that we can rip to the upside. It didn't look that way. We are still chopping. We're not even up entire percent here, but be aware of it. Expect unexpected in the stock market at any given time. I'm going to wait here for Jeff question. Excellent. Jeff, I'm going to answer that question in a moment. Let me just put this thing together and explain what the bear call is, and then I'm going to address your question. Fair enough? So just give me a second here. Okay. So bear call spread. Again, we have an adjective which describes a noun. The call by itself, it doesn't mean bullish. When you have a word bear in front of it, it's bearish. So that means it implies that the trend should be bearish, and we expect that kind of thing. We expect that kind of thing. So now go back one more time to the chart and make sure that I have this. Like, I'm going to just float this for a second, so I can have it here. And I'm going to just revisit the chart one more time. That we have a bearishness on it. So what I mean by bearishness on it is very simple. This. So the fact that we lifted, that we're close to 37, it doesn't mean anything because it needs to take out the next level that is an obstacle, 37.25. But even then, we're still 10 points away from my strike price, and my strike price is right here, 37.35. And this 37.35 that I'm talking about is my unit that it's out of the money. It's a unit that I want to have as a commanding unit because it's supposed to increase. So if we rip even higher, right to the gut of this UFO, right to the, let's say, 37.40, then this unit is going to be profitable, right? So I have a bear call spread because it's a short-term bias to the downside. It doesn't require necessarily any rapid drop. If this thing just keeps on chopping, that's fine too. Disclaimer, disclaimer, disclaimer. What's the disadvantage? The minor drop might not be enough to realize the maximum gain if you had traded at the money bear call spread. Luckily, we haven't traded at the money bear call spread. What we have traded here, if you really look at it, it's another out of the money bull call spread. So just like this is out of the money bull call, this bear call is also out of the money. We have a same sold unit right here, exactly same sold unit here, which is 37.40. But then we have a higher unit, and I'm going to just add this right above it, and I'm going to kind of borrow some of these numbers here. So you would see here that we pick actually 50 call. And that 50 call, you remember, we paid insignificant only 60 cents for it, and we got the wider, this is a wider spread, okay? That has given us the credit of the 45 cents. So there it is. So everything is laid down here. Which cycle should be selected for the bear call spread? In my case, my personal preference is if I'm a seller, I want to have a least amount of time exposure. That's what I like. What doesn't work for me, when the market goes up, volatility starts going down. So the highest uncertainty is pretty much at the beginning of the day when the market is opening. Market maker doesn't know what to price this. So they price out of the money unreasonable, but I'm not, well, in the case of the bull call spread, I am a buyer. But in the case of the bear call spread, I am a seller. In this case, I have a cold broken wing butterfly that I ended up getting the credit of the lousy 15 cents, which is really $15, but it pays off for both of those commissions, you know. So if I want to select the right cycle, it should be shortest possible amount of acceptable time for me to hold on to this risk. This cannot be done in the last minutes of the market being open. It's just there's no more premium from volatility left. Again, timing of the entry, it should be done one more time where after resistance, and this 37.35, it looks to me like a pretty good resistance. Okay. Outcomes. Well, let's back up here. Before the outcomes, could I talk about the two building blocks? So we have a first leg that is a higher strike price that allows the owner to sell the lower strike price. Without me owning that 37.50, I wouldn't be able to sell the 37.40, right? And that's how I get that net credit of the difference of the two. So execution is placed at the same time, and it's very important that I get the highest possible credit. Okay, having done the explanation of the theory behind it, let's now combine these two things together. So I'm bringing up here again this particular spread. And what I'm going to do here when I go edit, I'm going to actually add an option leg. And the option leg that I'm adding is that buying option leg at the 37.35. The 37.35 we did for $1.35. Now notice as of now everything is 111. I need to make this into 2, and then when I click OK, you will get exactly the chart of the or the profile graph of the broken wing butterfly. And the reason why I'm bringing this thing up is because it's so easy to rush through these things and not to understand what is really taking place in terms of the bigger picture. So let me just take a snapshot here, and of course this is going to be defined, this particular case, as unknown, which is really not correct. This is known as a broken wing butterfly. So called broken wing butterfly. Here's a whole enchilada explanation of it, how we got that. So one more time, we sold the 2 units, which is the gut of the butterfly, after 37.40. We got the $1.05, but we got twice. So that means we got 210. So when you subtract this $1.95 from it, because when you add the 60 on the top of $1.35, that's what it is, you still have a credit. So having said that, I want to now move to the risk graph and point out to you the highest amount of premium we are actually getting if we are right here at 37.40. So right here, if you're at the 37.40, then we are getting the maximum of the 500. Well, yes, if you're really lying, it's not a 500, it's 485. So Jeff, why do you think it's a 485? Why is not the 500? Because we actually paid 15. Now stop, think about it. Could you go in a bank, pull up the $15 and give it to them and I said, I'll come back when the market closes and I like to have instead of that $15, $485. What do you think the reaction of the teller would be? You don't think they would think that you're nuts and maybe call the security to kind of escort you outside of the bank premises? But this is pretty much what their trading unit at the Merrill Lynch or at whatever the company is doing with investors' money. With investors' money. So be aware of it. This strategy, it's worth its price in gold. However, it's a low probability strategy. But the reason why I'm teaching you right is because would you agree that if the market stays where I am, where we are, where I am, where you are, then my trade is dead wrong. We are tempted to go higher, but we got stuck below the 3700, which is right what I said to you at the beginning, dead in the middle of that range because we have a range between the 3600 and 3800 and we are right now dead inside that range. And there's really, there's no trade to be had because if you choose any trade at any given time, you can be proven wrong. Oh, over here, you're right on your bullish trade. Oh, now you're wrong on your bullish trade. And then you go bearish and then it reverses. Oh, no. So now the future traders who can just trade it directionally up or down, they're very different than option traders because option trader, you can sell the cover call or you can turn it into another spread or you have options. With futures, it's black and white. There's nothing in between. There's nothing in between. It's just two extremes. Two extremes. But with the call butterfly, we have a beauty of it. So Jeff, I'm going to now address the question. How do you exit call broken wind butterfly? This, in my opinion, is completely perfect question that I was hoping to get when I was preparing for this lesson. I'm going to bring the chart one more time here so I can entertain this possibility. I love the fact that I can exit this in pieces. You need to first understand why I have created this the way I have created it, and then you can actually appreciate how you exit this. So let's play out the scenario on a 5 minute. So I'm going to now put this on a 5 minutes, and you would see we are zigzagging. First we rallied, we came down, then we again reversed rallied, then we came down, and now we're currently rallying. If we go up all the way, this is approximately where that area of the red UFO is. So I should make this into a red rectangle here for me, and I can then entertain this whole possibility in depth. So this is approximately where I would like the price action to go. So let's say in yellow, I have movement to the upside, and we move to that area right here. Somehow that color doesn't look very good. Let me change it to blue. Okay, so we rip to the upside and we come into that area. So Jeff, what I would do, good morning, Mark, good to see you. What I would like to do on that case, I would like to then grab my bull call spread that is in the money, whatever the value is. Because be aware of it, my bull call spread only costed me $3. Even if it lived to, let's say, 37, 38, and this is the day of the expiry, I can take the intrinsic value and account for it. Think about it. What is in that case my 37.35 worth? If this is now few minutes before the expiry. My 37.35 call at that point is, well, you can say at the money or in the money, but in this case, because it's $5 spread, I'm going to call it at the money, is worth $3. Now stop and think about it. If it's worth $3 and you paid 30 cents for it, Jeff, would you agree with me? Yeah, Mark, no problem. You can watch the recording. I really walk very slowly to explain this called Broken Wing Butterfly. So just watch it. This is one of those rare lessons that probably one or two times you would need to watch it till you get it. So Jeff, would you not agree that making $3 or $300 on a 30 cents or a $30 investment is fantastic? At that point, I would not hesitate to take it off. Now, let me tell you, if I take this thing off, do I have a slight problem? Yes, because how did I arrive here that I only can lose $500 minus that $15? You're looking at this and look, well, wait a second, I'm kind of not following you. This bear call spread has the width of $1,000. Notice that this width of this bull call spread, it's only what? $500. So if this is the width of $500, then the market maker knows, like, wait a second, you can't lose those all $1,000, because if this thing rips and it gets to the 37.40, or in our case that we are discussing 37, what do we have, 38 or something like that, we're talking 37.38, they know that that can be intrinsically work. So then on the broken with butterfly, what they do, they actually subtract those things. $1,000 minus 500 is a 500, but out of that 500, $15 was a credit, so all that you can lose is that. So Jeff, to continue answering your question, be very careful when you're taking these things off, because once when you take this thing off, you're assuming that at that point the price action is going to, and let me recreate what I had here earlier, and I'm going to try to use the same colors here as I'm explaining this so you would understand. So we actually have here the area that we're targeting. So we're targeting this area on different time frames. It's at 37, 35, right? And we're assuming that price first lifts to it, then I take the bull call off, and the price ends up going where? Right back down. In that case, I would be so happy because I left the bear call spread on, and that bear call spread has completely expired what? Worthless. I have written the article, and I'll look up that article and I'll actually put it in the chat box here, because I did this thing on Tesla, and I actually have that whole thing explained. So I'll just need to go over here and find where those articles are. I'll put it in the chat in a moment here. But Jeff, that makes sense. Please type in something so I know. Again, I can now revisit Thinkorswim platform and see how's this thing bleeding out. So over here, I have placed that for a 15 cents. If I go over here, it will show that now it shows it's open and it's losing 35 cents, but it's tying up that amount that we discussed a moment ago. So just be aware of it, that if I would click right here, it would give the same numbers, exactly same numbers. So when I go over here, confirm, you see there's that $485. $485 of the possible what? Maximum loss. Now there is a place where you need to be aware of it, that this thing can stop. Jeff, it's all about the price timing. It's all about the price timing. That's why I really want to look up that article that I wrote on a Tesla, because it was a real trade that I had taken it, and I was sharing it with Jose, and Jose said, "Yeah, this sounds good." I said, "You know what? Maybe I can just write it as an article and kind of walk through the steps and kind of explain it how I did that." But the timing is everything, because just be aware of it when you're looking at the chart. I don't want to say you need to be a visionary, but you need to have a pretty good grasp of your technicals to understand what is most likely going to happen. So this is a 55-minute chart. This is a chart with which we started. And we're looking at this and saying, if this thing is going to lift on a Friday of the expiry, is there a possibility we might rip all the way to the upside? Pretty low. It's actually very, very low possibility that this could happen. This very low possibility that something like this could happen, but possibility is there. So you can take a chance. You can take a chance, and you can actually look at it and see if that is one of the possibilities that it could happen. And if it is, then you're saying, okay. I'm just looking for articles here to see if I can pull it up. That one that I was talking to you about. So I don't know how far back this is. It must be the last year that I have written this. That's why I can't even find it. Yeah, we're meeting here on Tuesday, and I'm like, how about I bring that link, and I have read the article, but I don't really remember. Yeah, I mean, this was on a Tesla, and it has to be now almost 2 years ago that I published that. Um, I don't think it was in January, but it was a trade that I have unwound in exactly the same way. So let me just explain one more time the way how it happens. So the Tesla trade that I have taken had a very similar situation in terms of the setup. It had a setup that it was so obvious that it's going to hold. So this whole area was the area that I was targeting, and I placed a cold broken wing butterfly. I know it's a mouthful, and then when it lifted to the upside, I did not hesitate to take off my bull call spread, because just by the uh, sheer weight of that thing, like nothing goes up in a straight line up. Take a look. This is like a 90-degree lift. Take a look. This is a 90-degree lift. If you kick the ball in the air, forces of gravity are going to eventually what? Pull it down. But this needs to be looked to the left to see what is there, right? In this case, we are looking to the left and we are seeing this resistance. Plus, we have this unfilled order. And plus, another thing, maybe I kind of rushed over it, and I should have maybe emphasized that the numbers were just staggering. You see the gut that I have picked here? It's at 17,000 contracts. Well, Yosif, why I didn't do this 38? If I try to do two or 38, it would be maybe 5 cents. Okay, let's try to do it on 38 right now. So how do we execute it? I put the mouse on a gut that I want to sell. I'm not going to sell it. I just want to price it. So Jeff, so you would understand better. So we have a lower one that we are buying. We have a gut. And I think the reason why those numbers are so high on the volume, because it's just a round number. And then we need to jack this up to be $1,000, right? So this is a structure. This is $1,000. This is a 500, and this right now is showing me that I would get the credit of 30. You know what I can do now? If I go over here and switch into different account in the IRA, I wonder if it's gonna get filled. See, this is now clean account, because what I did over here, I have two accounts. See, I knew that this was mispriced. There's no way that they're gonna give me for 30. Okay, but it's a paper trading account. They're gonna give me for 30, right? So in that case, you could say like, well, that's trade even better, right? Because but keep in mind, where are we right now? We are now at the 37.07 when I initially have opened up the trade. Now, let me pull up the document, because I have recorded where we were when we open up. When we open up, the market was sitting at this at the 808, or whatever. Like I did like for 8 minutes, like a big picture, and then I said let's fire the trade in. I think it shows right here. It was 809. I'm sorry, I was wrong by a minute. And then I get the 15 cents credit because we're so far away from it. We're like, gut was at the 40. We are here at the additional 25. That was like $65 difference between where we were at the time versus the target. Now we're no longer, we are virtually at 37.10, and I'm aiming the 37.50. That's about the 40 points. So of course it's different. Of course it's different now. Be aware of it, that this thing is lifting. And as I mentioned to you, a lot of traders right now, a lot of traders. Let me just bring this up one more time, man, because it's for me it's essential that I have this thing displayed before I end this session. Expect unexpected. One of the days when I suggest traders to take a day off in a month is a monthly expiration. Just because this is at this level, it doesn't mean we're gonna stay at this level. Look, the Dow Jones with all the bad stuff and also going into the weekend is ready to take up the high. Did anything change at the gas station? Did anything change in Ukraine? Did anything change in Europe? With their heating oil issues? No, nothing has changed. So could this be just a natural kind of market maker manipulation? And that's why I have built this. And I mean, it's a beautiful tactic, Like I mean, from all the things I have taught you, I think today is a real pearl. Because if I'm dead wrong, at least to get paid $15 pays out for commission. But if I'm right, I can unwind it. But as Jeff typed it in, price timing is so critical. Yeah, price timing is so critical. We could end up making the $485. I think I've traded, tracked my statistics. Like I think it was like 21 trades of the call broken with butterfly that I did. Only one out of the 21 closed somewhere near the gut. It wasn't exactly at the gut. But I was like, oh, so it really happens. But it took like 20 trades not to, and then the 21st trade actually closed. I was like, oh, let me take a snapshot of that. I was so surprised because I wasn't really expecting much of it. But again, expect the unexpected. So one more time, recap of everything that we have done. When we started the session, we looked at the S&P. We concluded that S&P is currently stuck in the range between 3,600. Let me move this again to daily. 3,600 and 3,800. It's basically in this huge box, And I don't want to say sit on your hands, because that just doesn't make sense. Well, today maybe it makes sense, like you said, sit on your hand, But I mean, like you can trade. The market. Is just that when this thing is dead at the 3,700, it has an equal chance to go up and it has an equal chance to go down. So in that case, I'm sorry to say, you just can't be directional. I mean, it's not clear. So I then decided I'm going to teach this call broken with butterfly because nobody can accuse me, oh, you're bullish on the market, because I'm bullish on the market with the what? With the bull call. But I'm also what? Bearish on the market. And then the net, I'm really neutral. So here I took a 45 cents to pay for this 30 cents. But here at the end, at least I get paid for my frustration. Okay, my timer just went off. So I'm done with the session. Thank you once again, Mark and Jeff, for interacting with me, and to all of you who are present. Please watch this as many times as you need to. It's a really valuable lesson. And as always, I'm going to see you again on Tuesday. Have a great weekend and see you on Tuesday. Bye bye.